Hi, and welcome to Crypto for Advisors, a podcast by Synergist. More than a third of Australians are into crypto, yet nearly 90% of advisors will not discuss it with them. I believe this is exposing investors to unnecessary risks, compromising the value of advised relationships, and limiting investment performance. My goal is to educate advisors and investors to bridge this crypto service gap while strengthening advised relationships. So let's get into today's episode. Today I'm joined by Professor Chris Berg, co-founder of the RMIT Blockchain Innovation Hub and one of Australia's leading thinkers on how new technologies shape freedom, markets and society. Chris has written extensively on blockchain governance and digital rights, including his book, The New Technologies of Freedom, which explores how innovations like blockchain and cryptography can expand individual liberty. So Chris, it's great to have you on Crypto for Advisors. Welcome to the show.
Thank you so much.
We're going to go through three different topics today and see how we go. The first one is around talking about blockchain and why it matters to advice clients. Then we'll sort of try and move into a little bit around privacy and freedom and compliance, and finally we'll talk a bit about regulations and the crossroads that we're at the moment domestically and also globally.
Sounds great.
All right, let's dig into it. Most of our audience are advisors, so financial planners and accountants, and they're not really sure on why this technology should matter to them, especially now, currently today. So what are your thoughts on the immediacy of this technology, especially in regards to financial planners or accountants and advice clients?
Well, absolutely. So, I think it's incredibly important that financial planners, really anybody in the advice industry or really anybody in who focuses on trends and challenges in the financial sector needs to be aware of some of the interesting complexities and opportunities that this technology is, in part because people are buying it. It is part of most consumers. Well, it's a part of the choice set of most consumers who are choosing to make an investment or even engage in financial activity on the internet. So a financial advisor needs to understand, at the very least, the pros and cons, the opportunities and challenges that it might bring. I think I would go a lot stronger than that as well, though, because I do think it's a really important, critical part of the future of finance too, as well. So to learn about cryptocurrency and blockchain technology more generally is to identify ahead of time the patterns of exchange that are going to occur in the future. What is the financial sector going to look like in the future? We've seen so much innovation, and in the last couple of years, we're seeing really significant interest from institutional investors, but also large firms that have decided that they're going to start implementing this technology into their basic financial products. So a general awareness of of what blockchain does and what cryptocurrency does, I think is important just for us as citizens as much as consumers and investors and advisors and so forth. So I think those are the really two big ones. The final point, though, I'll also make on that is that cryptocurrency, a lot of people buying cryptocurrency, a lot of people are buying and trading cryptocurrency. And cryptocurrency has its own very interesting and particular challenges that I think consumers and investors, particularly retail investors, really need financial advisors to be able to help them with. It's not just, should I buy this asset? It's, if I'm going to buy this asset, should I keep it on an exchange? Should I take it onto the blockchain? What are the security demands that would place on me if I was to do so? I think there's a lot of interesting new challenges that I would suggest financial advisors can really lead the way in thinking about.
Yeah, I think it's interesting as you see this, crypto, in particular blockchain technology evolve, how it sort of starts branching out different use cases for different types of people. And, obviously when it first started, it was very much driven by libertarians and not your keys, not your crypto kind of mentality. But we're sort of moving into or evolving, I guess, into a more mass market appeal, where a lot of people that I talk to would say, well, no, I don't want the responsibility of having to hold a cold wallet somewhere and try not to lose these seed phrases, because if I lose them, I lose everything. I can never get it back. That worries them too much, and they'd rather trust an institution. Does that go against, the core essence of crypto in your mind, and blockchain, or do you think it can happily coexist?
No, not it doesn't go against the core ethos in any way. I think the underlying vision of crypto and really any libertarian driven financial movement as you've described it, and I'm one of those libertarians, so I'm very passionate about taking self-sovereignty and so forth. But the core point of that is choice.
Mm.
That people have the choice and ability whether they want to trust large financial institutions or not. Now we have the capacity to make those choices ourselves. So we can interact with this in a way that we're trusting cryptocurrency exchanges, or we're even trusting banks that might provide custody service. Or we can do what you're describing, which is take it off chain, look after the keys ourselves, manage all our wallets and all those sorts of things. Now, in my view, that latter approach gives us a lot more control, but it also gives us a lot more opportunity, and you can engage with the technology in a really interesting way from an intellectual level. But I'm interested in that sort of stuff, and not everybody has to be, and not everybody would want to be. And we've got the institutions and we've got the services available so that you can just buy and hold on an exchange, and you can do so relatively safely and take advantage of the parts of the technology that you're interested in.
Yeah. It's yeah, and I think you mentioned, education was a key thing that you recommended that advisors, should be doing, is learning about it. And I think that, there's a that's a really important point, because how you might engage with this technology, and this asset class, if you're coming at it from an investor's mindset, um, might be very different in that first iteration, in that first instance, when you're first just trying to come in and get some exposure to it and start learning. But then as you learn and as you educate yourself, then it opens up more and more pathways to go down, if you are intellectually curious about it like yourself, or if you decide that, perhaps you don't trust the government or the institutions holding your crypto, and you want to retain that control yourself, or whatever application. There's lots of different pathways you can go down, but it's about, the core is about educating yourself and learning about it so that you can make an informed decision around what's right for you.
Yeah, I think that's right. And I don't think we should underestimate the conceptual difficulty that a lot of this cryptocurrency and blockchain technology presents for a lot
Yeah.
of people, because it is quite different. It is genuinely a radical change in the way we think about financial products and the way we think about financial services. There has always been, until blockchain and cryptocurrency, there has always been someone you can call for help. There has always been a customer service line to the bank or any financial institution that you deposit your funds with. Now, if you go the full extreme, as we're describing, which is you take it on chain and you look after your funds yourself and you're managing your own wallets, there is no one to call. It is entirely on you, and not that doesn't just create difficulties purely from a how do I manage my money perspective, but it's also, as I say, it's a conceptual jump between the way that the economy has worked and the way that the economy is working now. Now, I think over the last couple of years, we've gotten to a stage where there's a lot more, there are a lot more services, there are a lot more platforms that do hold your hand, that do walk you through some of these challenges so that you don't need to know about how to write a smart contract, or you don't need to know what the consensus mechanism of the blockchain is in order to interact with it, as you may have
Mm.
10 years ago when I was first getting interested in this technology. In the same way that you don't need to know exactly what the business model of your bank is in order to deposit with them, or you don't need to know how the payment system wires are tied together in order to make a payment at the supermarket. But on the other hand, there is still this big conceptual change that people need to go through in order to fully utilize the interesting benefits of the technology, especially if they want to take it onto the blockchain.
Yeah. And the two key barriers that I tend to hear the most when I'm talking to financial advisors in Australia is either that it is their perception is still anchored in those early days, like 10 years ago, like when you first started in it, as you said, when it was it was very speculative, and there was, strong potential it could fail and would have been worth nothing. But their perception is still rooted in that. And so there's this sort of nervousness or apprehension that it's a speculative bubble. It could all bust and go to zero. Uh, and the second barrier tends to be around. Look, we operate in a highly regulated environment. There's all of these best interest conditions and other ethical obligations and duties that we have to adhere to. So this difference, as you described it, this fundamentally different way of doing things, it makes us nervous because it doesn't necessarily reconcile with this highly regulated, structured environment that we operate in. So what are your thoughts on those two obstacles?
Yeah, look, it's a really interesting problem. And to put my public policy hat on, I think this was part of the historical mistake that was made with the future of financial advice reforms was to massively increase the regulatory burden on the financial advice sector at the very same time as technologies like blockchain and more generally that democratization of finance and investing that people really want, which we obviously saw most famously in Robinhood. So now we have very expensive advice matched with completely unregulated advice on platforms like TikTok because people need financial advice, but the regulatory frameworks has made it so expensive for people to get to. I think that's a huge problem that needs to be tackled by the government to free up the financial advice sector so that it can provide advice at a time when people need it the most. The financial sector has never been more complicated. We no longer just buy and hold shares in the big banks as maybe previous generations did. It's just harder, and there's more demand for engaging retail engagement in finance and a feeling that you should be able to take control of it yourself. Wouldn't it be great if we had a financial advice sector that was able to meet that demand at an affordable cost? But unfortunately, the difficulty is right now that it's so highly regulated, as we all know. Now, I'm hopeful that there'll be public policy change. I'm hopeful that there may be at least public policy change so that we get more and better AI-driven advice. But nonetheless, that's a big challenge.
If you were sitting in the inner sanctum of ASIC or the Treasury Department, what changes would you be advocating for? What would you like to see?
Well, so I think the best interest test needs to be relaxed. It's a huge problem. Look, I'm not a financial advisor, so I don't deal with this every day. But as I understand, it is a huge challenge to identify best interests, and it makes everybody very skittish. How do you know what is in the best interest of someone who you've only got certain visibility into their financial affairs? Certainly, all that they're willing to share with you. The other thing, though, is so I think that's a problem that's been created that needs to be fixed. But also, I think that we need to be a little bit clearer about the ability for robo advice and AI driven advice to work in the best interest of clients. As I understand it, the degree to which we can use robo advice is to a level of genericness that is just not that helpful. Generality is the word I'm looking for there. A level of generality that is not helpful in the environment that we need it. But of course, these new technologies are fantastic. They're capable of doing really highly specific and very accurate information if they're tied together very well and built very well. So I think if I was in the treasurer's office, if I was in ASIC, let's clear up the best interest problem and let's figure out ways that we can at low cost allow advisors to start using more AI.
Yeah, fantastic. My understanding of the AI is that you need to treat whatever is coming out of AI as if it's coming from a human. If you're a practice and you're leveraging AI, you're just as responsible for whatever's coming from AI as if it was a human. Knowing what actually it's referencing and how it's making those decisions before it's interfacing with the client, potentially without any human in the middle.
Not going to help you with the best interest test, right? I mean,
You can't hand on your heart necessarily say that it counts, does it?
Yeah.
So it is tricky. Where we're seeing it is in things like statements of advice, in compiling those things and then reading them back out to the clients and highlighting particular points so that the client is actively engaging and verifying yes, yes, yes. That a lot of that is more about covering the backside of the planner from a compliance point of view and having a nice, neat audit trail, I think. But but it's really interesting, that if you think about that best interest test, my understanding of it is it really came out or got strengthened after the Haynes Royal Commission. And it was really getting driven out of the banks in particular, vertically integrating down their wealth businesses and having tied distribution and then a whole range of other payment issues and commission structures that the findings were that it was driving product selection decisions. There was financial reasons driving product selection decisions rather than client centric. It would be interesting your take on this, but I'm a bit of more of a market purist in that sense that I look at it and I say, well, you shouldn't be just fixing that with regulatory burdens. You should be opening that up to the market and allowing innovative businesses to come in and actually find better solutions, because ultimately whoever meets the customer's needs at the lowest price is going to win in an open market. And it's just that the banks had at that point in time a vice-like grip on a lot of the clients who were at that higher net worth stage of their life. So
Yeah, and I think that's right. I'm putting the conflicted commissions aside. I think the choice that the government needs to understand, or really anybody who's thinking about what the regulatory framework is, should be, is not between having bad advice from financial advisors and having good advice from financial advisors. It's between having good advice from financial advisors at a very high cost and effectively no advice. And we're in a no advice situation at the moment for many, many people. And in a no advice environment, what happens is not that people don't make financial decisions. They do make financial decisions, but they make them on the basis of Reddit threads or TikTok
mhm.
videos. And again, the question is not, should we allow people should we allow robo advice and we should allow advisors to use AI for financial advice? It's, should we allow them to provide custom advice? Everybody's going to use ChatGPT anyway for this. This is available to them already. We should be, as thinkers about policy and trying to make policy recommendations, we should be urging the government to allow that the development of custom and high quality AI platforms for financial advisors. And as you're suggesting, in the current environment, well, if you have to figure out the best interests after the fact anyway, and you have to do all the work anyway, well, why would you use AI? You're not getting any productivity gains.
I read something. I think it was a SwiftX survey, and they found that more than 80% of investors were using social media influencers,
Yeah.
basically, for their financial advice, their primary source of financial advice.
And that is a demonstration of a really clear public policy failure that has not broken through to Parliament's awareness.
And I think even the advice industry isn't aware. I mean, the two stats that I repeat ad nauseum is that 32% of Australians already own cryptocurrency.
Mhm.
So the market has decided that this is a legitimate asset class. But 89% of financial advisors won't talk to their clients about it. Roughly 50% of advisors that I talk to would say, I will never talk to my clients about crypto. No way. And for a variety of reasons. And it does create that tension that you're saying, where it forces that consumer to either stay out of an asset class that's been the highest performing 9 out of the last 12 years, or go and get into it off there by Googling, how do I invest in crypto, and just hoping that they click on the right link. Um, and that is that's a policy failure. I'd like to jump into the third topic here, because we've started talking about regulations. There's obviously a lot of movement going on in the States at the moment. They've got Project Crypto that's come out of their crypto week a couple of weeks ago. The Genius Act, the Clarity Act, the Anti-CBDC Surveillance Act, anti, yep, and the Bitcoin Strategic Reserve. And
but in Australia, no one really knows. We're just sort of spinning our wheels a little bit, as we go. But what I find really interesting is it seems that the approach that we're taking towards cryptocurrency is a fundamentally different approach to how the regulators globally are taking to AI. With AI, I think there's a recognition that if we regulate this, we lose the race. And particularly coming from the US, it's US versus China. This is a massive arms race, for AI. And if we regulate it, we're going to lose. And so there's much more of a lean into an open market, and then, other ways to sort of manage it and make sure it's evolving responsibly. Whereas crypto, it's much more we're going to manage this within the realm of our existing financial services regulations, and we're going to shoehorn it into, how we always do things, how we manage financial services. There seems, is that the way you read it? Do you see it as a completely different approach, and how do you interpret that?
Yeah, look, there are very big differences. You're absolutely right. The way I would characterize it is the regulators have been putting aside, where we are on the legislative cycle and so forth. The regulators have been relatively hostile to cryptocurrency because it is a barrier challenging innovation. So the technology itself and the assets that you can build on top of it challenge many of the core assumptions we have about the financial sector and how it is controlled. The idea of permissionless financial products is novel, and so much of our regulatory framework, and in fact, so much of the sort of financial political system, is based around permission, who gets to provide what products and what services. So it's not surprising to me that regulators have been out of the box so hostile to cryptocurrency and blockchain. Now, in the US under the Biden administration, they were incredibly hostile.
Mm, mm.
So there was there was a war against crypto, as one senator described it.
Checkpoint 2.0.
Exactly. So there are these enormous battles that have happened in the United States. Australia has been slightly different. There's been a general benign neglect of the sector by Parliament, really, really since it first emerged as a political issue, and I think 2014 was the first major political discussion about crypto in Australia, at least. Now, the Albanese government is apparently going to move ahead with some licensing regime for cryptocurrency exchanges. They have been promising to do so for quite some time now, so I hesitate to make any commitment that that's going to happen. And more recently, ASIC has been significantly expanded its legal action against some cryptocurrency firms, but around the definition of, well, what is a financial product and so forth. But the courts have been a bit hostile to that, to be honest. In practice, there have been some big losses that ASIC has had. So there is a lot of movement in the United States. The Trump administration is very pro-crypto for the most part. And the Albanese government is much less pro-crypto, but it's more uninterested, I would say, in cryptocurrency, which is a huge mistake in my view, because I think there are really big opportunities for us. And if we wanted to capture those, and we wanted to capture the jobs and benefits from that as well. Now, AI is different though. So AI is a new category of product. We haven't been able to make intelligence on the computer before. And so there isn't obviously a regulatory framework that it would fit into. Now, a lot of, in fact, recently the union movement has been trying to squeeze sort of workplace safety regulation so that it would apply to AI. So different governments have tried to do sorts of things, but for the most part, most governments have recognized that this is a massive productivity opportunity for us, and we want to capture the benefits of that productivity because it's not obvious how we would regulate it otherwise. And that's a good space for the AI industry to be in. I'm glad that they're in it. I wish the cryptocurrency industry was enjoying such gentle support from our governments.
Yeah, that's a great take. I like that benign leadership comment as well. That sort of sums it up nicely. And as one of my previous guests said, it seems that the regulation is always 18 months away. That's the running joke. How far away is it? 18 months. If we think about the regulation in the US, the Genius Act's been passed. That was signed into law on the 18th of July. And the next one is Clarity Act, which has passed the House and it's debate in the Senate at the moment. And I think I'm not 100% sure when that's likely to come through, but people are probably saying weeks away rather than months away. It's pretty close from my understanding. It seems that when that comes through, that's going to provide regulatory certainty for how to interpret whether something's a financial product, whether it's an asset, whether it's a security. And that will then give existing financial institutions, the clarity to be able to enter into this space with their own products and services. So do you think that there's likely to be a scenario here by the end of the year that Main Street banks in the US will be offering crypto custody services to their clients, offering crypto-backed lending products to their clients? Do you think it's that far away, or do you think it's still years away?
I don't think it's years away. It's not that difficult once the regulatory clarity has been solved to offer these products. And there's been a lot of proofs of concepts. All the major banks around the world have been playing with the technology really from day one. Here as well, too, for that matter. So I don't think it's a difficult product. Now, what does a crypto lending service look like if you're a bank? Well, it doesn't look like a mortgage, which most people are familiar with, because there may be concerns about under collateralized lending and all these sorts of things. But it won't be that difficult for banks to offer those sorts of services. Whether the really big banks will, whether Citibank is going to offer that sort of thing, or whether it's smaller banks that are already in the crypto market, as many have been, and many are returning after Operation 2.0, Operation Choke Point 2.0 has ended. More generally, I think the stance of the administration really helps the sector in the US and here. So much of the regulatory framework is structured around the discretion-making powers of the regulators themselves. And I speak to American crypto firms, and they've got a very different attitude about the risk of any innovation than they did under the Biden administration. Their real fear is, well, what happens after the Trump administration? Does it go back to where it was? And do the choices that we made during this administration, will we come to regret them during the next one as well? Which is why legislative change is so important, which is why we don't just want to face the political stance of the administration or the political stance of the regulator. We want to see legislative change, because legislative change is permanent or semi-permanent change. And that's what needs to happen, and that's true here too, right? So we need to see Parliament lock in a regime that would make firms in Australia comfortable to, for example, sell tokens, launch projects in Australia, offer lending programs.
Yeah, and as you said, that's hopefully not too well. It's imminent in America, and hopefully it's not too far away here. And given that a third of the population own crypto already, you'd think that the Australian politicians will, when they get into the next voting cycle, start paying a lot more attention. It's interesting about the concerns in the US around the change of administration and what impact that might have on any changes that wash through. But I guess maybe I'm being a bit cynical, but I'd imagine if there's enough money being made, then there'll be no changes. It's sort of like the opposition of the day always fights any tax increase or whatever, but then they never repeal it when they come into office, do they?
Well, yeah, I mean, that's quite right. If there's obviously benefits from a regulatory or legislative regime, or there's obvious benefits from a stance, then you would hope that would be convincing to the next people. It's not always the case. Unfortunately, the power of political ideology and the power of political partisanship in the United States is very strong, as you know.
Yeah.
And both sides of politics have been comfortable to really do really groundbreaking changes on the previous administration's positions, but you would hope that the benefits of this technology are so obviously demonstrated that this is a positive. In Australia, I'm a little bit worried, and I do agree with you that the amount of people who have interacted with this technology is really large. The numbers you're showing are a third of Australians are using it. My impression from the government is that is viewed negatively, though, because they feel that those people who've been interacting with them have somehow been caught up in scams and those sorts of things. I think the Albanese government, certainly under the previous Albanese government, they haven't spoken much after the last election.
Mm.
Under the previous Albanese government, everything was filtered through the scam problem.
Yeah.
Because in fact, in the last term, financial scams were a massive, massive problem. They're actually less so, and some of the things that the government has done, not to do with crypto, just in other fields, has actually cut down the rate of scams, to my knowledge. But everything was filtered through that scam problem, and so when they thought about crypto, they thought about it as a problem to be solved, not as an opportunity to be grasped.
Yeah.
I hope that's changing.
Mm.
And I hope that the positive experience that the vast majority of crypto users have will filter through when they start thinking about how to regulate.
Yeah, the scam lens, it's an interesting observation that it's absolutely, tends to be the default mindset for a lot of more traditional participants in the market, that third of the population are into crypto, they're being scammed. And I think that it's a generalization that can be really dangerous, because there's scams and there's fraud, and it's criminals and all that, but the technology itself is actually far better for fighting that, and than cash, for example.
Yeah.
And so it's not the technology. Maybe 5 years ago plus 10 years ago, absolutely, it was a different story. But the transparency of it, the immutability of it, the traceability of it is much, much, much better than in cash, for example. So I think what they probably mean is more that there's a few speculative elements of crypto, like meme coins or NFTs, which create bubbles, and then the bubbles burst, and they see that and they think that that's a scam. Whereas I don't see that as a scam. I see that as a sector of cryptocurrency that everyone who participates in it knows that there's no inherent value in any meme coin. It's purely, it's not really investing. It's more akin to a sports bet account than a Robinhood account.
Yeah, well, I mean, the inherent value of a meme coin is entertainment. So
That's right.
but of
Like
course,
gambling.
the complexity of that, and why this is sometimes such a hard sector to really get your head around, is that from a smart contract level, a high quality investment and a meme coin and an NFT look almost exactly the same.
Yeah.
So the platforms treat them almost exactly the same. There are some mild complexities there, but from an engineering perspective, they're basically the same thing. So imagine that you're a policymaker and try to navigate when very serious financial institutions come to Parliament and tell you about their high quality products, and then your child is talking about investing in the stupidest meme coin in the world, and they're basically the same thing from an engineering perspective, but they're very different economically. This is what happens when we invent general purpose technologies. People use them for just different things, some of which are to be silly and some of which are to make serious investments in the economy.
There's humanity on show. But when you link it back to what you were saying before about, serious institutions bringing out lending products, and it's not going to look like a mortgage, and they've got to grapple with all of this variability within those tokens. And I actually spent a few years when I was back, 20 years ago, when I was at ANZ Bank. One of my roles there was in the margin lending business, and I actually see it very similar to margin lending. What we would do there is we would have an approved list of securities, in this case tokens, and we wouldn't lend on all of them. We'd only lend on the ones that met our risk criteria, And then we'd have a loan to value ratio, an LVR, for each of those as well. So depending upon what that token was, what security was, you would lend a different amount. And I think that that's probably, if I was to guess, I'd guess that that's probably the evolution of where the lending, approaches will end up going. Because how do you, stack up Bitcoin against Fartcoin in the same conversation? It's quite hard.
Yeah, exactly right. Exactly right.
Great. So one more thing that I really want to drill in is that concept of freedom. This technology has the ability to be able to unlock a whole nother layer of freedom for society if it's approached in the right way. But at the same time, we're trying to grapple with a system where you need to protect people and we need to protect against bad actors. So how do we reconcile that in an advice concept around KYC and AML and surveillance to determine your lending, how much they're prepared to lend? They can look at all your expenditures and all of that. How does that reconcile from a freedom point of view with this new technology around blockchain or distributed ledgers?
Yeah, look, I mean, there's two ways to answer that. The first one is, what is the evolving public policy conversation about this at the moment? And in some ways, it's trending in a way that I'm not comfortable. Some regulators, some law enforcement agencies, some governments are viewing it as a way to expand financial surveillance and financial control onto the internet. So, for example, proposed regulations that would mean that even wallets that are non-custodial, so wallets that I control my own keys as if I'm putting money under my bed, entirely under my control, would have to KYC. I would have to KYC for them. I would have to KYC potentially if I send you funds. We'd have to KYC each other. I think when that would just not be the case, if I was just to give you a present of some dollars. So that's trending in a negative way. On the other hand, the technology is moving very, very fast, so it's difficult for regulators to stay on top of this. More generally, I think this is so that's the first way to think about it. Well, what is the direction that the public policy frameworks are traveling? The second one is, what is the opportunity that we get from this? And at the first instance, this technology has already made us more free. This is a technology that has given us the capacity to take more control over our funds, take more control over our financial destiny than we had before Satoshi Nakamoto invented Bitcoin in 2009. We are more free. In fact, you could go further and you could say that the world's monetary regimes are better off, given that everybody on the planet, to the extent that they have access to the internet, has access to an alternative money regime called Bitcoin or called any of these or US dollar stable coins. They've just got more access to more financial services and the ability to interact with anybody anywhere on the world. That's new and that's novel, and that's a very material increase on some people's on a lot of our freedoms, in fact, particularly if you're in a regime with poor monetary policy, or if you're in a regime where your banks are being slowly disconnected from the global correspondent banking system. I think we talk a lot about, in the crypto space, we talk a lot about the ability for crypto to bank the unbanked, which is give people access to financial services when they don't have access to bank accounts. Now, I'm worried about that, and I'm ambitious for crypto to solve that problem. I think there's a more severe problem, which is that whole countries are getting unbanked because of the increasing financial surveillance imposed from many rich countries. Many poor country banking services are being debanked from the global correspondent banking network. And that makes it really hard if you're an immigrant and you want to remit funds back to your family, if your family's bank was just kicked off the correspondent banking network. Now, stable coins, other crypto assets, they solve that problem. So in that sense, we're already freer because of this technology, and we already have more control. We already have more access to interesting, complex, and sometimes very risky financial services than we did before, because ultimately it is a technology that's democratizing. Because it's permissionless, anyone can use it. So you can use it, I can use it, and anybody else can.
Awesome. Um, so, Chris, just to wrap up, maybe if I could ask you a bit of an out there question, but let's pretend that you were a financial planner and that you were setting up your own financial planning practice from scratch. What would you do differently given this technology in this asset class?
So I worry that my main role would be to lobby the government to change the regulatory framework. I think there's the opportunity for really substantial innovation on the AI side as well, even subject to some of the limitations we have. I've been waiting for really rapid innovation in that space, and I don't think we've seen it yet. That may be because the AI is moving so fast that it's hard to keep up. Like GPT-5 was released just the other day. It's changed the way I work. I'm sure it's changing the way we could get financial advice too. I haven't tried to talk it through my superannuation or anything yet, but I will. So that's what I would do. The other thing, though, I would do if subject to regulatory limitations, is there's a massive need for advice, not just what assets to buy, how I should hold them, those sorts of things, but how I should interact with them, because it's not like you don't just go to a broker to buy cryptocurrency. You buy it, and then suddenly you've got all these choices in front of you. Even the simplest exchanges to use will give you two separate withdrawal buttons: withdraw money to your bank account, withdraw crypto onto the blockchain. And just talking people through what it means to do the latter, what it means to have a wallet, what you can do once you are on the blockchain, all that sort of thing. I think that's the education opportunity there. So not just about the assets, but about how to use the assets. What are the cybersecurity challenges? Now, whether we call that a financial advisor or a general crypto advisor, I don't know. That sounds like that's a problem for the financial advice industry. I'm but an observer, but I think that's a huge opportunity.
Yeah. You're really highlighting the distinction between crypto as an asset class and blockchain as a technology, and they're used interchangeably, all the time. But really, it's a fundamentally different use case, and they represent so many different things. There's entire industries which are being transformed due to distributed ledger technology, blockchain technology today, including financial services. But crypto is really just seen more as an asset class, as an investment class. Should I have some crypto alongside my Australian equities or my US equities or managed funds? And so part of that education is probably helping people draw a distinction between that and understand that it isn't the same thing, and not all crypto is created equal. And blockchain has a whole diverse range of use cases of how it can benefit productivity and efficiencies.
Yeah, that's absolutely right. There's just an opportunity here where there's a demand for education. Now, I would say that I'm a university professor. This is where we make our money. But I do think it's just so new. I think, generally speaking, the technology changes that we are living through right now and are going to live through are going to put a lot of extra burden on advisors, consultants, educators, people who can help people navigate these massive changes.
Or we'll just ask ChatGPT.
Or we'll ask ChatGPT.
Chris, that's been fantastic. For our listeners who might like to, keep across your commentary, I follow you. I really like, the insights that you provide. What's the best way for them to keep across you?
Well, I'm on LinkedIn. I'm also I've got my own website where I post all my commentary, chrisberg.org. I've also got a Substack. Let me put it this way. I'm very easy to Google, Andrew. So just jump in and see what you can.
I'll put some links across the screen here for you to make it even easier for people. But I really appreciate your time, Chris, and your insights. I really enjoyed the chat, and hopefully we can do it again soon.
No worries. Thank you so much, Andrew.
Thank you.
This podcast is for informational purposes only and does not constitute financial advice. All views of Andrew McPhee and his guests are their opinions only and do not reflect the opinions of Synergist. You should not treat any opinions expressed as a specific inducement to make a particular investment or follow a particular strategy.